Charlie Munger built a $2.5 billion fortune and helped Warren Buffett grow Berkshire Hathaway into a $1 trillion empire. But the secret to protecting his portfolio wasn't diversification. It wasn't market timing. It wasn't complex hedging strategies. It was something far simpler and far more powerful. The big money is not in the buying and the selling, but in the waiting. Today, I'm revealing Munger's #1 portfolio protection rule. The one thing that could save your portfolio from permanent loss of capital this year. Here's what Munger understood that most investors don't. Portfolio protection isn't about avoiding losses. It's about avoiding permanent loss of capital. There's a massive difference. Temporary losses, a stock dropping 20%, 30%, even 50%, are part of investing. But permanent loss of capital? That's when you sell a mediocre business at the wrong time and never recover. Munger's solution was brutally simple. Only invest in businesses you understand so well that you can hold them through any market condition. He said, "The idea of diversification makes sense to a point if you don't know what you're doing. That's not arrogance. That's self-awareness." Here's his framework. If you can't confidently hold a stock through a 50% drawdown because you understand the business, its competitive advantages, and its long-term trajectory, you shouldn't own it in the first place. Munger's portfolio protection strategy has 3 components. Miss any one of them and you're gambling, not investing. Component number 1, quality first. Munger convinced Buffett to evolve from buying cigar-butt stocks, mediocre companies at bargain prices, to buying wonderful businesses at fair prices. Why? Because quality protects you. A great business with a durable competitive advantage can survive recessions, market crashes, and management mistakes. A mediocre business at a cheap price? One bad quarter and it's over. Look at Munger's personal portfolio: Wells Fargo, Bank of America, US Bancorp. These aren't exciting. They're not going to 10x in a year, but they have decades of consistent earnings, durable competitive moats, management teams that allocate capital intelligently. That's what protects your portfolio, not excitement, quality. Component number 2, margin of safety. This is the non-negotiable. Never pay full price for anything. Munger searched for ways to invest below intrinsic value. Even when buying wonderful businesses, he demanded a discount to what they were actually worth. Why? Because if your valuation thesis is wrong, and it will be sometimes, the margin of safety gives you a cushion. You might not make 50%, but you probably won't lose 50% either. Component number 3, patience. Here's where most investors fail. They find a great business. They buy it at a fair price. And then they sell it 3 months later because it's down 10%. Munger held Wells Fargo for over a decade without making a single adjustment. Same with Bank of America. Same with US Bancorp. His philosophy: if you took our top 15 decisions out, we'd have a pretty average record. It wasn't hyperactivity, but a hell of a lot of patience. Portfolio protection isn't about constantly adjusting your holdings. It's about making a few great decisions and giving them time to compound. So what's the #1 thing that could save your portfolio this year? It's not a stock pick. It's not a sector rotation. It's not a hedging strategy. It's this: stop trying to protect your portfolio from volatility. Start protecting it from stupidity. Munger said, "A lot of people with high IQs are terrible investors because they've got terrible temperaments. The biggest threat to your portfolio isn't a market crash. It's you panicking during that crash and selling your best businesses at the worst possible time. The biggest threat isn't missing out on gains. It's chasing returns in businesses you don't understand and losing everything. The biggest threat isn't under-diversification. It's over-diversification into mediocre investments that dilute your winners." Here's your action plan. Step 1, audit your portfolio. If you can't explain in 2 sentences why you own each stock and why it will be more valuable in 10 years, sell it. Step 2, focus on quality. Stop chasing cheap stocks. Start demanding wonderful businesses at fair prices. Step 3, build a margin of safety into every purchase. If you're not getting at least a 20 to 30% discount to intrinsic value, wait. Step 4, commit to patience. Give your investments at least 5 years to compound. If you're not willing to hold for 5 years, don't buy at all. That's it. That's how Charlie Munger protected his portfolio for 70 years. Not through complex strategies. Through discipline, quality, and patience. The market will crash again this year, or next year, or the year after that. But if you own great businesses bought at fair prices with a margin of safety, you'll be fine. Because portfolio protection isn't about avoiding pain. It's about positioning yourself to benefit from other people's panic. That's the Munger way, and it works. Hit the subscription bell for more update.